The new steward of Berkshire after Buffett. How Greg Abel is reshaping value investing.
Now that Warren Buffett has stepped back from frontline management, Berkshire Hathaway's trillion-dollar empire has officially entered the post-Buffett era. Many investors worry that the legendary fund's glory days might fade and that traditional value investing has become outdated. Yet Greg Abel, the confirmed successor now calling the shots, has rolled out a series of bold moves that deliver a clear message. Value investing is far from dead. It has simply evolved to fit the new era.
Buffett is a once-in-a-generation investing genius, boasting unparalleled vision and intuition that carried him through decades of market cycles. By contrast, Abel is a down-to-earth, risk-focused operator who prioritizes practical results above all. Low profile, media-shy, and never one to chase hype, he is the man Buffett personally handpicked to oversee this massive capital empire. Abel's pragmatic mindset stems from his humble roots. Born into an ordinary Canadian family with no wealthy connections or elite academic credentials, he started his career at PricewaterhouseCoopers as an auditor. 4 years of poring over financial statements, auditing accounts, and identifying risks forged his core investment philosophy. Trust only real profits and steady cash flow, not market hype or empty storytelling.
Most people only know Abel as Buffett's heir apparent. Few realize he is one of Berkshire's most seasoned industrial leaders. More than 30 years ago, he joined a small energy subsidiary of Berkshire, starting in an entry-level finance role. Through steady efforts and strategic mergers and acquisitions, he transformed the regional power company into one of North America's top utility giants and a leading player in U.S. wind power and new energy sectors.
While speculators chased market fads and empty concepts, Abel focused on building power infrastructure and securing stable cash flow from real businesses. With decades of experience managing capital-intensive industrial assets, he understands a timeless truth. Best businesses deliver consistent profits and withstand market volatility with minimal risk. This unwavering pragmatism is exactly why Buffett entrusted him with Berkshire's trillion-dollar legacy.
Abel's first major portfolio reshuffle after taking office caught Wall Street completely off guard. Breaking from Buffett's ultra-conservative, hands-off investing style, he launched sweeping adjustments. He more than doubled Berkshire's stake in Google, liquidated over a dozen underperforming stocks to streamline the entire portfolio, and boldly re-entered the airline sector, reversing Buffett's earlier pessimistic stance on the industry.
The market quickly labeled this shift as Berkshire chasing the AI boom, but this is a total misunderstanding. Abel never blindly follows trends or overvalues speculative tech stocks. His heavy bet on Google is rooted in solid, down-to-earth logic. First, Google generates consistent, massive profits. Its core search and YouTube advertising businesses deliver robust, reliable cash flow year after year, serving as an unshakable profit engine. Second, its AI technology is no longer a theoretical concept. It has been fully commercialized. Google Cloud's revenue surges annually, and AI algorithms directly boost advertising efficiency and corporate earnings. Third, the stock is reasonably valued with no obvious market bubbles, offering a solid margin of safety. Most importantly, Berkshire's extensive power grid and energy assets perfectly match the surging power demand of AI development, creating a powerful synergy between its industrial holdings and investment portfolio. Similarly, his decision to divest Amazon and several financial stocks stems from simple logic. These businesses look prosperous on the surface, yet they feature thin profit margins, slowing growth, and poor cost performance, failing to meet his standards of stability, sustainability, and profitability. This highlights the core difference between Abel and Buffett. Buffett favored simple, passive profit-generating sectors like consumer goods and insurance, and long avoided technology stocks due to their complexity. Having navigated industrial upgrades and industry iterations firsthand, Abel recognizes that sticking rigidly to traditional industries will only lead to gradual decline in a fast-changing market. Even so, he never takes reckless risks. He steers clear of speculative AI small-cap stocks, unproven new concepts and market bubbles. He retains massive cash reserves as a safety buffer and holds core blue-chip assets including Coca-Cola and Apple. His core strategy is simple: uphold fundamental value principles while embracing legitimate era-driven growth opportunities.
At a time when AI mania dominates the market and most investors chase short-term gains blindly, Abel's rational approach stands out sharply. He never overturns Berkshire's time-tested value foundation, nor does he cling to outdated conventions. Instead, he optimizes the portfolio with industrial thinking, weeds out underperforming assets, and selectively invests in leading tech firms, proven, profitable AI applications.
In the post-Buffett era, Berkshire has avoided both reckless speculation and rigid stagnation. Abel has proven with his pragmatic actions that value investing never becomes obsolete. What fades are outdated mindsets, rigid prejudices, and refusal to evolve. Going forward, Berkshire will no longer rely on legendary once-in-a-lifetime investment miracles. Instead, it will gain greater stability, rationality, and the ability to evolve with the times. As a low-key and pragmatic leader, Greg Abel will steer this trillion-dollar giant steadily through the market ups and downs of the next decade.